It's a big day. We're going to be talking about real stories, real people, real strategies, real wealth. We're going to be introducing Making a Millionaire.
Brian, that is right. I am so excited because they're finally letting us talk about it. We have been planning this for months and months and months and months. We have a brand new show coming out for you guys that we want you to get so excited about, and it is coming out in the next few weeks.
Well, let's go ahead and just tell them when it's starting.
I know. I set you up to tell them.
Okay.
You want me to tell them?
The premiere date is going to be Monday. Oh, no, the February 3rd, 8 a.m.
Monday, February 3rd, 8 a.m. The plan is we will release a new episode every 2 weeks. So if you aren't used to consuming our content on Mondays, get ready because every other Monday at 8 a.m. we're going to have a brand new Making a Millionaire show out there for you to see. We're going to do a deep dive sitting across the table from individuals, from couples, from millionaires or millionaires in the making to show you what it looks like when we actually get to apply the abundance cycle. Brian, we talk all the time about the abundance cycle is you want to learn and then you want to apply and you want to grow. Well, the Money Guy Show is where you learn, is where we put all the education out there, but we also want you to see real life case studies of that information being applied to people's actual financial lives and how it can truthfully lead to a great, big, beautiful tomorrow.
Well, I thought it was, what I love about this is that we really are getting to open up the curtain where, like, we did an episode on Friday, and this couple that came in, they were even sharing how their influence back in the 90s was a former financial advisor that became very popular and was just telling everybody, no, cut. You can't do this, you can't do that. I love that we get to show people empowered in the fact that it's not always the cutting. It's also expanding and thinking about all the things you should be doing or can be doing or even do more to make more memories because you've got the numbers and everything's lined up. You just need to give yourself permission. So we're really kind of going in depth to what a real financial planning relationship works and looks like with like fee-only financial advisors. So we get to essentially flex the muscle of what we do in our day job.
And I love that what you're going to see is you're going to see people that are at the beginning of their financial journey. Maybe they're just starting out. They're just trying to figure out what they're going to do in their finances, all the way to people who are at the financial independence level and some of the advanced strategies around what to do in retirement and how to think about your assets and how to think about decumulation. So our hope is that there's going to be something for everyone. There's going to be a lesson to learn in every single episode. And we are so excited to get to unleash it to the world so that you guys can see it.
But we can do better than just me and you talking about this.
Yep.
I think we thought it would be really helpful, and the content team did this for us, if we gave you kind of a flash of what to expect with Making a Millionaire.
Everybody growing up wants to be a millionaire. I want to show all the viewers that, yeah, it is possible.
So do you think you can beat the market right now?
No, I have, but no.
Well, you just keep giving me the disclaimer.
My dad really educated me, again, like I said, on the value of money, and then it made it harder to just go and spend it.
Your unique situation is because we have to come to you where you are. We're triaging your personal situation right now in real time.
Might you be at the stage of your financial journey where it's time to
Calm down.
I'm gonna say grow up. And then at that point, that's when you get to build your great, big, beautiful tomorrow.
Welcome to Making a Millionaire. Boom shakalaka.
So there it is, Making a Millionaire. We are so excited for you to get to go on this journey with us. If you would like to be on Making a Millionaire, if you're someone who thinks you may want to apply that, you can go to moneyguy.com/apply. And maybe you want to tell your story. You want to have us do a deep dive with you. We would love to do that because we love answering questions. We love answering your questions. That's why every Tuesday at 10 a.m. we do this live stream where we can load you up. So right now, we have the team out in the wings collecting your questions so that we can help you do money better. So with that, senior creative, nope, that's not it. Senior content writer, that's not it.
I thought when I saw you grab the sticky note that you had written it down, but you didn't. I don't know what you, sorry, Megan.
Hey, Megan, that's what I'm going to say.
By the way, everybody, I want to cut everybody off, but everybody's like, where's Reby? Did we never tell everybody?
No, we
Reeby's
did.
on maternity leave.
Yeah, but a lot of people who come here, they don't get to see everything. They're interacting. That's exactly where she's at. But I'm going to give them a pass. They might not have known that. They might not have known that she was out with the
We
family.
mentioned it like once, I think. So.
Well,
Have you missed a week?
and by the way, Megan, everybody's crushing it. You're doing a great job.
Big Megan
But I
fans
just
out there.
also wanted to make sure I filled in the gaps for other things I see in the comment section.
Yeah. Also, real quick before we get started, if you want to learn a little bit more about making a millionaire, you can go to moneyguide.com/makingamillionaire. And all of the information that we just talked about will be up there for you to look back and read through. So, all right, you ready to start with some financial questions?
Yes, ma'am.
All righty. This first one is from Kyle C. He says, my wife's job offers a deferred comp plan through her job. What are y'all's thoughts on the pros and cons of that? We are already maxing out her 401k and doing each of our backdoor Roths. So what do you guys think about those deferred comp plans?
Yeah, so why don't you, Brian, you let me define what a deferred comp plan is, how it operates, and then maybe you can talk about some of the pros or cons or how someone decides if they're going to use it. So a lot of companies, when you work for them, say, hey, we're going to pay you X salary per year, and this is going to be your income. But you might be at the place say, hey, I actually have a standard of living where I don't need all of that income coming in to be able to pay my bills. I would actually be willing to push some of the income that I earned this year into future years. So that way that it's not taxable to me. So I'm going to defer that income to some point in the future. Maybe it's 5, 10, 15, 20 years out. And then at that point in time, I'm going to elect how I want to receive that income. Maybe I want to receive it all as a lump sum when I retire. Or maybe I want to receive equal payments over my first 5 years of retirement or 10 years of retirement. So deferred comp plans allow you to do that. They allow you to push off current year income into the future. Oftentimes you can then invest those dollars so that they grow and you get to control the income stream that you receive later on, often building yourself like a mini pension through your deferred comp plan. But it's not all rainbows and unicorns. There are some things you need to think about, and there are some things you should measure before you decide if you take advantage of it.
Yeah, let me first tell you, how is this even possible? If you're asking yourself, how in the world can you take some of your income, not pay income taxes on it until some future date? How does the government even allow this? Well, the way they allow it is that you're essentially saying, hey, employer, instead of taking this income now, you keep it, put it on your balance sheet as a liability to me so that I don't actually receive the income. So that's why it's not taxable to me now. But now you're going to keep it on your liability side as an obligation and pay me at some point in the future. Well, that problem with that is, this is the big risk. Everybody who does deferred comp, look at your company, maybe even go pull the balance sheet for your company to see how in good financial situation they are, is because if they went broke before your obligation or promise is fulfilled and they paid you back or started paying the income streams, you'd get in line with every other creditor out there. So that's why you do need to at least make sure that your employer is on good, stable ground financially. I do like these, especially for any of my clients that are thinking that they're going to retire pre-65 or, before 66 or 67, depending on where their full retirement age for Social Security is, because this allows you to essentially, as Bo said, create a pension. Now, there's a caveat there. You need to go read the rules for your deferred comp, because for some of them, if you say you change your mind or you either get laid off or you just decide to leave this company, some deferred comps do allow you then to start getting paid that money over time, like over a 5-year period. But some others, their document is written in a way that it just unloads on you all at once and creates a huge tax bomb right as you change employment. So I always tell people, make sure you read all the rules. This is a very personalized decision, but it is great. I've had quite a few executives who, and here's the cool thing, like you choose that you're creating a 5-year bridge. What if you decide you want to keep working 5 years in the future? Typically, these plans allow you to kick the ladder out an additional year in the future.
There are some things that happen.
So you get to keep kicking it out though, and make the decision and build up your essentially your ladder of deferred comp gets bigger and bigger and creates a bigger compensation bridge for yourself. But you got to make sure that you measure twice on this, because there's a lot of rules, and usually you have to make these decisions really far in advance too. So that's why it typically requires a lot of planning. This is definitely something that when you're you're like, man, I've never done this. Wouldn't it be nice if I've dealt with somebody who's done this hundreds, if not thousands of times? This is definitely one of those things where you might want to take the relationship to the next level. This is one of those areas where life gets very complex very quickly, and you want to make sure you get it right on the first shot at this.
Can I ping just one other thing on there, one other little question? Kyle, he said, we're already maxing out our 401k, and we're each maxing out our backdoor Roths. Where in the financial order of operations do you often see deferred comp happen? Like, is it something that someone who's right at the very beginning of their journey should take advantage of, or how do you know when it makes sense?
This is, if you're trying to figure out where in the financial order of operations, this is definitely a step 7 hyperaccumulation, because this means you're beyond the basic plans. We're way beyond Roth IRAs. We're way beyond just maxing out your 401k. This is for people in very high income situations. And now you're thinking about, when you get to step 7 of the financial order of operations, is what's the 3 bucket strategy? What am I going to have access to? When do I actually plan on leaving the workforce? How am I going to integrate that into my financial plan? That's why this is a great tool to take into account and use as you do that high level planning.
Love it.
Great. Sounds like you're giving Kyle a lot to think about. Thanks, Kyle, for your question. Next up is a fun one. This is from GBB Tomorrow. He says,
oh, yeah, I like that.
He says, our 11-year-old son, who has invested his earnings over the last few years, is passionate about math and finance and is enjoying Millionaire Mission.
Oh, nice.
What is the best place to hold his investments? We know he can open a youth investment account at 13, but until then, we're holding his investments in a separate account in our brokerage. Do y'all have any tips for?
Well, I mean, there's so many cool things in this question. Yeah. First, 11-year-old, and I couldn't hear if you read this part, who's invested his mowing earnings. This is earned income.
He's making money.
Now look, for people who just opening up an account for a child and you want to take advantage of their lower tax rate than yours, custodial accounts are great. You know, the UGMA or UTMA. And then, before that, even you have 529s. But as soon as your children actually learn the value of hard work and they start making money through their labor, their time, I love custodial Roth IRAs because if he's wired this way, why not you? And by the way, you could prime the pump and do some type of matching formula, whether it's 50 cents on the dollar, dollar for dollar. Remember, you can't exceed what they make. Your contribution can't exceed what your earned income limit is when you're making Roth contributions. But that way you could at least allow him to enjoy some of the fruit of his labor as well if you did some type of matching formula. But I love priming that pump to kind of really encourage that good behavior of discipline and letting your money work for you.
I love, this is a great example. Even starting at 11 years old, you can use a tool like Millionaire Mission. Brian, will you hold the Millionaire Mission thing up? You can even use a tool like this to teach your children financial concepts. It's not so complicated, not so difficult that they cannot grasp it and they cannot get excited about it, so that you can have them beginning to form those habits at a very early age that they'll ultimately take on later in life. In terms of accounts that might be available for you, I love that you mentioned the custodial Roth. Whenever it comes to like kids' accounts, I always say, think about what the ultimate goal for these dollars is, and generally it falls into 3 distinct buckets. If the goal is for college or for higher education, 529s are a great solution. If the goal is for like retirement or financial independence, custodial Roths are a great solution. And then if the goal is for something more intermediate in term, and maybe it's for the first car or a down payment on the first house or some other goal they want to save for, well, that's where an UTMA might be a fantastic solution. So you ought to have that conversation with your kid and say, hey, which one of these goals do you want to fund? Which one of these gets you excited? And it doesn't have to be all or nothing. You can actually have a child who has an UTMA set up and also has a custodial Roth set up. There's nothing wrong with doing that, especially if your child is taking an active role in the process.
By the way, everybody ought to go to moneyguy.com/resources, play around with our wealth multiplier. I went and pulled it with my handy dandy little cheat sheet here. For an 11-year-old, every dollar has the potential to become $216.51.
That's amazing.
Wowzer.
Insane.
I get excited about every dollar for a 20-year-old becomes 88.
That's way more exciting.
11-year-old, $216.51. That's mind-blowing.
Wonderful. Thank you, Great Big Beautiful Tomorrow, for your question. That's some really exciting stuff. All right, next up, we have a question from the head cat. He says, I feel like I'm not being paid enough for the amount of work that I do at my job, but my boss is great and has helped everyone so much outside of work that it makes me feel selfish to ask for a raise. Is this wrong of me?
Well, I think it doesn't have to be a win or lose discussion. But you're sitting here, and I'm going to let Bo fill in some color on this, is because he's the master of creating the win-win scenario. And I like to think that I did this with my first boss at the CPA firm. I know he used to probably dread every client ride that we'd have, because we'd be stuck in the car for 30 minutes, and I'd use this time to pepper him about career path and where we see the firm going and opportunities that I can make his job easier. And Bo, that's what I want to give you credit for with me. You're so good at it. You actually own part of the business now. So, man, kudos to you for being so good at this. Is that I always felt like you presented when you wanted more. You didn't do it out of the obligation of saying, hey, I'm a good employee, just give me more money. You always presented, hey, what if we do this, this, and this? I think it's going to create more revenue here, here, here. And then you made it a win-win.
That's right. Yeah, I always tried to structure it in any sort of like, I don't want to call it a negotiation, because it should not be a negotiation. I think that's a bad term for it. What it should be is a mutually beneficial conversation. That's what you ought to have with your employers. Because it's one thing if you meet with your boss or meet your supervisor and say, hey, I want a raise. That means I want more money. And if it's the owner of the company, you make less money. That automatically puts you at conflict and misaligns your interests. If instead you can say, hey, I was trying to figure out, I was thinking, hey, if we decided to do this, or we moved in this area, or we tried this strategy, or we used this sales tactic, or whatever that thing was, and ultimately it's going to drive more revenue by increasing sales or increasing your revenue growth, or maybe we're going to cut expenses by figuring out some better way to do something. Hey, I would love to spearhead the initiative to go on this path. Is that something that would be valuable to the company? Well, what I found in my experience and what I see with a lot of our clients is if you can find ways to make yourself incredibly valuable, where either you increase the top line, you decrease expenses, and ultimately increase the bottom line, you generally, especially if you own that, will have a much stronger footing to say, hey, this would be something great if I could also participate in the growth. Hey, if you make more money, I make more money. We're on the same side of the table. That's a much better way to approach this conversation than, hey, I think I'm valued up here and you're valuing me down here and I need you to come to me. I just think that you set yourself up for confrontation that way. So if you can find some way so that it's good for all parties involved, even if it's a supervisor, hey, how can I take on more responsibility? Hey, are there things I could do that would make your job, your life, your day easier, better, more valuable? Hey, I'd love to take those on. And if you can create a consistent habit of doing that, you become so valuable to the organization that they can't ignore you. They can't possibly not create a path for you to move along in the organization.
And then I'll sound like the old man on the front porch yelling at the sky, is know where you are in the time frame too. Because now I am shocked, because I'll see in the comments section, we even have some loved ones, you find out people haven't gotten pay raises in 8 years. And I'm like, and that exists?
That's a different
because
thing.
Like we in our organization, we give pay raises, we look at things every year. But I've had situations, and this person, I would talk about this because I think they would even say, what was I thinking? Somebody had been here for 5 months, and we had a year end, and they asked if they could have a meeting, and they kind of said they wanted a pay raise. And I had to remind them, I was like, where do you think you are in this career journey? Because in the first 5 months, you barely know how our processes work. Yes, you have a strong aptitude, but you have to have enough time to kind of absorb into the system, because there is a balance in the beginning of an employer relationship. Your employer is giving you a lot more than you're probably giving them. Most people don't start day one and start adding tremendous value to a company. It takes a while to kind of absorb practices, to get good at it, to become proficient at something. So don't, if you've only been there for a few months, go in and then demand a pay raise when you might be at the beginning part of the learning cycle. Just be careful. I know there's a lot of content out there saying that you can't get ahead unless you do this, that, and there. It's just, but be very self-aware of where you actually are in that value add. Because there's what we always say is value what you receive, price is what you pay.
Yeah,
well, a
price is
lot
what
of
you pay,
times
value
that's
is
what
what you
happens with
receive.
wages as well, is that you have to make sure that you understand what is the value of the whole relationship as well.
I love it.
Great. Thank you, the head cat, for your question. All right, next up, we have one from D and J. They say, can Brian and Bo share what helps them switch over from saver to a spender? Some background for context. I'm 36, married with a 3-year-old son, and have about $2 million invested in mostly index funds.
Nice. Hold on. 36?
Yeah.
36 with $2 million invested? You're crushing it. I mean, objectively, not knowing where you live, anything else you have going on, if you have $2 million saved up at the ripe old age of 36, you are crushing it. So let's pause there for a moment. But also, you got a 3-year-old. So you're kind of like messy middling it also, right? Like I bet you have a lot of different stuff going on every day. And you probably feel this tension. Okay, I've made these decisions thus far in life to get me to where I am, but I also have these other priorities. As my kids get older, I want to create memories and create experiences. I want to be able to spend some of the money. How do I balance that? Well, I'll tell you, one of the things that I figured out early on was I was able to free myself of the spending guilt once I hit my 25% number. Once I knew that whatever my gross income is, if I'm saving 25% of that gross, and if I can start doing that early enough, I'm going to set myself up to be able to write my ticket for my financial future. If you don't believe us, we have a deliverable. You can go to moneyguide.com/resources and download the deliverable. What can 25% do for you? That's not the name, but that's what we call it. What can 25% do for you? And show you if you can start that behavior early on, by the time that you do get to retirement, by the time that you do get to financial independence, you get to pick and choose the lifestyle that you leave. Well, if you are here at 36 years old and you've already got to the $2 million mark, I would begin asking the question, where am I going? What's the ultimate finish line that I'm working towards? And do I need to keep running at the same pace that I have been running? Or is it okay if I slow myself down?
I always get nervous sometimes when we do content, I'll have somebody in the comments or in the live streams just say, hey, I'm 27, we make $500,000 a year, we've already built up. And I'm like, well, that's great, but you haven't turned that big shovel into enough assets or army of dollars working for you. But that's not necessarily the case for somebody who's 36 years old and 2 million. So I don't want people to shut off the savings or feel too comfortable too soon. So I'm usually trying to get people, especially early in their career, make sure you focus on the make wealth before you de-risk and start doing the maintain wealth behaviors. But somebody who's 36, 2 million, I want to encourage you, I think you ought to go ahead and run the numbers. You know, one of the things we have, if you go to learn.moneyguy.com, we have the Know Your Number course. And I think it would be a great illustration and exercise for you, is because when you put your numbers in, you put in your assumptions on when you want to retire, put in your rates of return, be conservative with it so you just don't get this thing to run crazy on you because you have so much money at such a really early age. But then you need to kind of know the stats. After you see the numbers, I want to remind you, this is something that kind of because you did specifically ask the question, how did me and Bo get from this? And I don't mind sharing part of my journey is that I realized that I was doing so good at being disciplined and saving, and I'm proud of those decisions because I couldn't tell you what dollar or what specific decision I made, which is the one that has led me to this great situation. Yes, some big decisions had big results, but there was a lot of little things that led to big results too. So I'm very happy with every one of them. But when I started seeing how big the number was going to be, I realized, you know, you see that stat, that 80% of millionaires, whether it's Millionaire Next Door, whether it's Ramsey Solutions, or even our own millionaire survey that we do every year, and even the surveys we did on all of our financial mutants out there, the stats are incredibly clear that somewhere between 75 to 80% of millionaires are first generation. Well, that stat only works if you understand how fleeting wealth is, or building resources, and the fact that second generation, meaning your kids and your grandkids, you know, it's going to go away very quickly. And that's why the stats show 70% for your kids, 90% for your grandkids. The wealth evaporates, it goes away. So if you have that knowledge of where your money's going, you do the homework, you actually do the Know Your Number course, you know the data and stats that I just shared with you, I think you'll have a different perspective. You'll say, look, I have now a balancing act, just like it was discipline that got me to this point by making these small decisions or saving this money. Now I need to be disciplined with knowing, hey, if I can't take this with me, what can I maximize to make sure that I don't have regrets at any decade that I live? And that's why I like memories over stuff, especially with kids, because I still want to encourage you, because if you're doing this at 36 and you have a young child, make sure you're building scarcity in their life. I always like that with like first cars. Don't go get them a new super nice car. You know, I like that I got my daughter to pay half for the first one. Make sure you are building some type of scarcity. You're giving them the understanding of how money works, that you're, you know, doing matching funds when they start working their first job. Make them go work fast food in high school. All those type of elements, but then also make sure you're loving on them with memories, great trips, invest in their education, all those type of things. And I think if you go through those exercises, you'll come out and be in a better place, and you'll also have a better understanding. That's why, you know, when I talk about Millionaire Mission, all of you financial mutants, you're like, I knew everything in the book except for the final 2 chapters. And I'm like, yeah, because we've been doing this content since 2006. I pretty much have shared everything I possibly can know, and it starts probably sounding over and over. But the last 2 chapters, I did spend a lot of time thinking about, what is wealth? What does it mean to me? What have I done to change my mindset so I can understand these things? And D&J, hopefully that helps, so that my experience can help you navigate these waters as well.
And then sometimes it's helpful to have a coach. I mean, obviously where you are, you've done a great job of accumulating and building. Sometimes it's nice to have someone in your corner saying, hey, it's okay if you spend money. Hey, it's okay if you back down the savings. I mean, Brian, you and I both in 2024 had some large capital outlays for some things that we were each doing individually. And we were able to have conversations around that. Hey, I'm thinking about doing this thing. Hey, I'm thinking about buying this thing. Yeah, okay, no, it makes sense. If you can have that sounding board, if you can have someone on your side telling you, hey, it's okay if you upgrade this, if you spend the money here, if you back down the savings here, because it still aligns with your long-term financial plan, sometimes having that person in your corner can be incredibly valuable. As financial advisors, it's one of our very favorite things to do. I mean, we love telling people, yes, save, invest, grow. Yeah, that's wonderful. But man, it's so fun when we get to say, hey, you know what? Now let's spend some money. Let's create those memories. Let's have those experiences. Let's do those things that you've saved up for all of these years. So having a voice of reason in your corner, communicating that to you can be incredibly valuable. So maybe now would be a great time to consider taking the relationship to a next level.
Yeah, I mean, well, we all have blind spots. I did make a big purchase last year, and I was just going to go make a sale and create a ton of capital gains. And Bo was like, because I was paying cash, and Bo was like, isn't that transaction 3 months in the future or 4 months in the future? And I was like, yeah. And he goes, it's kind of like a quarterback. Why don't you lead the ball where it's actually going to be? Do you really need to create all those capital gains at once, or could you be saving in the background, still take on some of those capital gains? And I was like, you know what? You're right. And you saved me a decent chunk in taxes, because if I would have sold everything when I put the contract down, I'd have probably been pretty ticked off when I paid that tax bill and those extra dollars, when that was just a blind spot that I had. Because in my mind, it was the better decision just to do it all at once. But in hindsight, and I like to think with your improvements that we've kind of had some really good discussions on that stuff as well.
Absolutely.
Love it. All right, D&J, thank you so much for your question. It sounds like you've got some really exciting things to think about.
Hey, Megan, can I just say 2 things real quick?
Of course.
Because a lot of folks don't come in at the very beginning. They come in right now. So if you're just now coming in, would you subscribe? We would love to know that you are a member of the Money Guy family. And we don't know that unless you click that subscribe button. And secondly, we made a pretty exciting announcement. If you just tuned in, you didn't check out the beginning of this show. We have a brand new show coming out, releasing on February 3rd. It's going to start at 8 a.m. every other Monday. It's a brand new show called Making a Millionaire, where we get to sit down and talk to millionaires and millionaires in the making. We want you to check it out.
So I think it's because you probably, in the first announcement, I stuttered on because I had the date, but I was like, I thought that was going to be a Friday. But then it hit me. I was like, no, do you realize, like, we'll have this coming out Monday. We have mini shows on Wednesday. Then we have
live stream on Tuesday.
Live stream on Tuesdays. Then we have the
Long
full
show on
episodes
Friday.
on Fridays. Wowzer. Man, when we started this thing, if you'd have told me that we're going to keep adding, just keep
New
pushing,
content
just keep
every
pushing,
single
keep
day.
pushing. So, but we love you guys. You guys are a big support system to us. Means a lot to us. And by the way, the counter's wrong right now. We have actually a lot more subscribers. We love for that. So we're going to get this in the meantime fixed. But I would encourage you, so we can get that thing really to spin over when we fix it, is please make sure you subscribe.
Yeah, and if you would like to be on that new show, you can go to moneyguy.com/apply. We've got some people in the chat asking about it.
And is that trailer just sitting out there for everybody now? Where's the trailer at?
It's on the YouTube channel. I think we're going to have it as like the intro video to our channel and
Oh, look
everything.
at
And
that.
it'll
That's
be on
awesome.
that Making a Millionaire page too. So moneyguy.com/makingamillionaire.
Heck yeah.
It's on there. So
I'm so excited.
It's going to be good.
It's a lot of fun.
yeah. And we've been working on this for a long time in the background. So
Yeah, and do y'all know how hard it is for me to keep a secret? I don't even think I've done.
Yes,
I think
we actively all do,
Well,
no.
I mean, you saw, and it comes the social media team put out and things, and Jake and others. Everybody, this is horrible. I mean, also we've been doing studio tours for months, and we're like, shh,
Don't take any pictures.
Yes, you're seeing the studio, but don't tell anybody.
I love it. All right, y'all. This next question is from Mutant P. Something in the chat?
Yeah, somebody just said, "What's Brian's workout routine? He's looking super fit."
It's
I just
layers.
thought
It's
I'd-
called wear extra layers. It gets cold. I think it's 15 degrees outside right now, so I just wear additional layers. Would you drop something?
I dropped my pen, but it's way back there. It'll be
Oh,
okay.
no.
I'm gonna really focus to you now.
Are you sure?
We could probably get somebody to crawl back there and get you a pen.
Look at
Let's
Look
see
at
if-
this.
Look
Oh,
at
look at this.
Caleb.
Just
Look
toss
at
it to him.
this.
He's a baseball player.
My man, thank you so much.
You don't do on-air math or public math or on-air catching,
Oh, no,
obviously.
I'd have caught it. Come on.
All right.
sorry.
Pen working? We're good to go?
Yes, ma'am.
All right. This question is from Mutant P. He says, I already contributed to my Roth IRA, but my side hustle had a surge of income and put us over the income limit. I know I need to take out 2024 contributions, but is there a way to put it back? So if you find yourself contributing to a Roth when you're in that income phase out, what do you do?
Walk them through the
Yes.
logistics of how
So-
you unwind this thing.
So first of all, this is a good problem, Mutant P. I mean, it's annoying and it's going to be a little frustrating. But what you basically say is, hey, I made a lot more money than I thought I was going to make. So let's just pause there. Great thing. That's good. Well, now that you're over the income threshold, the government has now said, hey, you can't put money directly into a Roth. So what you have to do is you have to go back in time and you have to unwind those contributions that you made. Now, what's great is since you haven't filed your tax return for 2024 yet, it's going to be a little bit easier than had you filed your tax return, have to go amend it. So all you have to do is you have to contact the custodian or broker that you work with and say, hey, I was ineligible to do the contributions I did. I need to now go back and pull out those contributions. And in addition to those contributions, I also have to pull out any applicable earnings. So if it made money, those earnings have to come out as well. And those will be subject to income tax as well as a penalty if you're under 59.5. But you never should have been able to make the money anyway, so it's not the worst thing in the world. So you get all of those Roths undone. And then the question becomes, okay, well, can I put it back in? If I couldn't do the direct Roth, what options does Mutant P have to still build up some tax-free dollars?
Well, and this is when you hear everybody talk about backdoor Roth contributions, but really it's a Roth conversion strategy. And I want to, because I had a dear friend who reached out to me. This was last year and was so excited because they had done. He said, I did my first backdoor, and I was like, wait a minute. Remember, all those conversations we had on my back porch is you have a rollover IRA, so you can't do it. He goes, what? And I was like, yeah, rollover IRA. You can't do. You only can do backdoor Roth conversions unless you want to deal with all the pro rata rules and all the other crazy basis things that have to be dealt with for taxes. Is if you clear out all your other IRA balances. So I'm talking about simple IRAs, SEP IRAs, rollover IRAs. The only IRA that really doesn't cause problems is inherited IRAs. But everything else you need to clear out or push it up into your qualified 401ks or 403bs. But if you do have a good structure where you don't have any other IRA accounts, you can make a non-deductible contribution into a traditional IRA, and then you can convert that into a Roth. Because remember, in 2010, they took away the income limits on Roth conversions. So it doesn't matter how much money you make to do a Roth conversion, but you just have to have the right structure so that you can do this on an annual basis.
So let's assume, though, that, okay, maybe I have the IRA rollovers or I have SEPs or SIMPLEs or whatever, and I can't do that. Does that mean that I just shouldn't save that money? No. Even if you can't do the Roth, and we love the Roth, we want you to be able to do it, do the back door, but perhaps you can't do that. You have to pull those contributions. There's nothing wrong with taking those dollars and just putting them in an after-tax brokerage account and still getting those to work for you. That's still one of the 3 buckets that we like for you to build. What we don't want you to do is say, oh, well, couldn't do the Roth. Guess I'll just take that, park it in my savings account, and not get those dollars working for me. That would not be a win.
Or go consume or spend more.
Or go consume.
All right, Mutant P, thank you so much for your question. Next up, we have one from Matt, the radar technician. He says, how do you approach...
Is that radar technician?
Yeah.
You said Raider.
The
Radar.
The Raider technician.
Did I say radar?
Did I hear that wrong?
Megan's
Did y'all
been
hear
hanging out with
Raider?
us. She's been hanging out with us too
I
long.
know. I got the
Honestly,
Southern
I heard
accent
Raider
now.
too.
Okay.
Well, Matt, the radar technician.
There you go. I like how she rolled it in there like a good Southern boy would. Meaning me. She mispronounced it like I would.
He says, how do you approach the net worth targets like 6 times your annual income and investments when your income experiences a big change? About 3 years ago, my income nearly doubled and my lifestyle increased as well.
Man, we actually get this question all the time because, if you've ever read The Millionaire Next Door, Dr. Stanley had a great formula in there where he said, if you take your age times your income and divide by 10, that'll give you an idea of where your net worth should be if you want to be an average accumulator of wealth. But if you want to be a prodigious accumulator, you want double that number. Well, that works if you are old enough that you've had enough time to accumulate, and your income is steady enough that it's an accurate representation of your lifestyle. But a lot of people, like Matt, said, man, my income, I just got a huge pay raise. Like last year, I was a prodigious accumulator of wealth, and then I got this pay raise, and I do the math, and all of a sudden I'm behind. What do? So we said, hey, there are some ways that you can think about approaching these targets, at least when it's like spot check in time. And one of the things that we talk about all the time, Brian, especially for folks who have like highly variable income or income that's increased rapidly, if you really want to assess where you are today, you can think about smoothing that out. Like, okay, what was the average income that I earned over the last 3 to 5 years? So maybe that factors in lower income years and higher income years. And that'll give you a better metric of, okay, have I actually been saving the way that I want to be saving? Because remember, all of these targets, like I want to have 6 times my income, I want to have 10 times. These are all like back of the napkin playing horseshoes. It's just giving you something to shoot for, trying to get close. When you actually work towards financial independence, in reality, it's not truly a multiple of income you're working for. You have a very specific and defined number that will allow you to live the life that you want to live on the terms that you want to live it. That's what you ought to be working for. So don't get so caught up if you're not exactly at that net worth target, because it's just supposed to be a guidepost moving you along the path.
Yeah, I like it. It's more of the napkin financial plans. If you're really trying to go a little deeper, like a financial mutant, I do encourage people. There's one of the reasons, if you go to moneyguy.com/resources, we have a free net worth spreadsheet, essentially, you can download and do. But if you want to actually have a dashboard view of knowing how to look at all the big changes, the bucket strategy of step 7, how your income compares to the growth of your assets, then we like the net worth tool because it does all these things that Matt, you're probably trying to deal with is how do I know how well I'm doing? If 6 times because of my doubling of income and maybe even income smoothing over the last 3 years doesn't do what I want, how can I take a more active role? I would tell you, turn it into an annual, at least an annual tradition of looking at your net worth statement so you can see how much of this increase in income is turning into assets, financial assets on my net worth statement that are growing. How much of my liabilities or my debts are being paid down? And I like looking at those annual incremental changes to kind of really get an executive review of how good am I doing with the resources that I'm blessed with, and am I turning this into assets? Am I paying down liabilities? It doesn't just have to be these 6 times benchmarks. I love that we give these things when we do net worth by age and all these other things, but there is a better way to kind of get into your actual numbers. It's not just a benchmark. It's actually telling you how efficient you specifically are being with your army of dollars.
I'll tell you one thing that I love. It's a little bit of a shameless plug. I don't know if we have, Nate, like a screenshot of our net worth dashboard. I don't know if we have something we could pull up real quick. But one of my favorite things about our net worth dashboard is there is a quadrant on there that's called Your Journey to Abundance. And what it does is, using the formula that I described earlier, it shows exactly where you are based on income, age, and shows you, like, am I an average accumulator, am I a prodigious accumulator? Well, your journey to abundance actually tracks it through time. So it'll show where you were 5 years ago and 4 years ago and 3 years ago. So what you can do is, if you look at this path and you know, okay, this was the year that I had a big income increase, you can see, man, for the very beginning of my journey, I was always a prodigious accumulator. I had this big income increase. Okay, now I'm an average accumulator. How do I get back to prodigious? So that way, it lets you see, is my behavior actually matching the mutant that I want to be? And it's why we track it over time instead of just looking at it right now this year. Your journey to abundance is what tells the true story of, are you saving and turning your income into assets like you should be?
Love it. Thank you so much, Matt, for your question. And if you're interested in that net worth tool, you can go to learn.moneyguide.com, and that's where you can get that one. All right. Our next question is from Boosted Bricks. This one's a little straightforward, but I think we get this question a lot. So, how would you quantify hyperaccumulation before moving on to step 8?
Brian, I'd love, because I think you talk a lot about this in Millionaire Mission, right? Like, one of the things that you talked about is hyperaccumulation, and how do I know that I'm there, and when do I move? As you were writing the book, what were some of the, like, thoughts that you had? You're like, okay, let me, because this is something that people get confused about, and they ask us about, and they question. What was some of the clarity you had as you were kind of penning those chapters?
Well, I mean, we talk about that all the time, that financial things are the actions you do, but it's also the preparation and the mindset you have. And I feel like and I've got to find it. I have so many things on here. This looks like my bedroom floor right now. If you look at the steps, step 7 is really an activity that you have to, all these are very actionable. If you look at, let's just take it from step 4, your 3 to 6 months emergency reserves, Roth IRAs, health savings accounts, maxing those out makes sense. Maxing out retirement, in a lot of ways, that means 25% of your income or reaching the federal limits that they let you do in those retirement plans. Step 7 is the first one where, instead of just maxing out every dollar, we start thinking about, in hyperaccumulation, how am I going to use this money? And I want you to take a pause at that moment, saying, I've done such a good job of being disciplined and saving. Where's actually the execution of consumption or using these assets? And that's why that chapter is devoted to talking about the 3 bucket strategy, being tax efficient, focusing on how you're going to retire, when you're going to retire, and how those accounts are going to be structured. And once you have a better understanding on that, by all means, I want you then to move to prepaid expenses or abundance goals, because that's when, now that you've done the homework and you know how you're going to use the money in step 7, you can now start thinking about step 8, where let's give the kids, load them up on education funding. This may be also step 8 is when we get into residential real estate investing or commercial real estate investing, or we just want to increase lifestyle. Maybe this is where we finally go buy the overpriced European sports car, or
you don't want to do that.
No, I don't want them to do that. But I'm just telling you, this is where you do these things, and it becomes a comedy punchline on your financial life versus being a disaster for your financial life, because you've already done everything else. It's okay if you make mistakes or expand your lifestyle because you've done everything else right. But hopefully that helps you out on understanding the difference or the progression to go from step 6 to step 7 to even step 8.
For a specific, quantifiable, measurable, I would say 25% savings rate has to be there. Now, maybe you're at an income level where you get to 25% and you're not out of your employer-sponsored retirement plan. That's okay. I would argue that you're still moving into that hyperaccumulation phase if you're saving 25%. But I think you got to be at 25% before you can even consider, am I at hyperaccumulation? Am I there yet?
At a minimum 25%, because you might not be going to step 8. Like, maybe you're one of these people that wants to leave the workforce at 48.
Yeah.
Obviously, if you're leaving the workforce at 48 and you're 32 years of age, you got to have a huge savings rate. You got to get, instead of it being step 7 is the step of hyperaccumulation, where you say, for most people who have a normal retirement, 25% is going to do it. But because you have this really big goal of leaving the workforce or living life in a completely different way at such an early age, you have to do more. And that's going to be determined in step 7. So that way you don't get to step 8 and you start increasing lifestyle, making all these consumption decisions when you're not even respecting how you're going to use the money in step 7.
Love it.
Great. All right, thank you, Boosted Bricks, for your question. All right, next up, we've got kind of a two-parter question from Nick S.
No, they only get one question.
Yeah, we'll answer our favorite part of it. The other one.
Keep going. I'm kidding.
He says, I'm 30 years old and I'm buying a new car. The car fits the 23-8 rule, but is it okay if they give me 4 years of 0% financing? Is it okay to use all 4 years? And then there's another question kind of tagged on the end that says, also, how do you prepare for paying for a wedding?
Oh, wow. Look at that. It's almost like he's playing that violin as hard as he gets to the crescendo because he's really trying to pull the heartstrings as much as possible to break 23-8. But I'll let you get into the details, but I'll answer one part of this.
Okay.
If they give you 4 years at 0%, sure, you can take it. Doesn't mean you use it, but it's sitting there in the background. I mean, this is often why y'all wonder where rules come from. I have been, there's a person out there that tells everybody to do like 15-year mortgages. Early part of my career, I was like, I'm going to do a 15-year mortgage. I did it. And then I had some big life things happen, and I ended up having to own 2 homes because there was a transition period. And I cursed that I did that 15-year mortgage because I could use that extra grace or flexibility if I'd have done a 30-year mortgage. Because it would have my payment would have been much easier. And it'd been easy for me to pay the 30-year mortgage in 15 years. But I liked I wish I'd had the grace of a little extra flexibility when I had to balance because I was moving houses and I couldn't sell the first one. It was nice if I could have had a little more margin in my life. Cars are kind of the same way. You can take the 0% for 4 years, but I still want you to pay it off in 3.
Yeah, before I moved to being an all-cash automobile purchaser, every loan that I ever took on an automobile, once I started taking finances seriously, was always 5 years. I always selected the 60-month option because every time I bought a car, there was no difference in interest rate over 36 months and 60 months. But then I would immediately, as soon as I stepped out of the showroom floor, and not true, I did it before I actually signed the paperwork, I would calculate what's my payment going to be to get this thing paid off in 36 months. So if they offer you the 0% for 48 months, that's great. We still want you to pay it off in 36 months because we know that cars are depreciable assets. And we know that if you're buying a new car, what is it? It loses something like 60% of the value in the first 4 years. Is that right?
No, it's 50 to 60% in the first 3 to 4 years.
And then it depends on the type of automobile that you're buying. I just think that for a financial mutant, you don't have to play these reindeer games. You will never be upset at yourself for getting that car paid off in 3 years. And I think if you're taking advantage of 0% interest, you're still going to be able to do something like have margin to begin saving for a wedding. Because that was the second part of Nick's question is, how do I pay for a wedding? How do I begin to save for that? Well, like all things in our financial life, we have to prioritize our goals. What are the goals? I have a goal of having a new car. I also have a goal of getting married. I have a goal of financial independence. I have a goal of home ownership. I have a goal of, and you fill out all your goals. Well, then you have to order those goals by priority. Okay, which one do I prioritize more? Having a wedding or financial independence? I'm speaking tongue in cheek here, but it will affect the decision. Okay, do I want to have the big, crazy, massive, blowout, awesome wedding that's going to cost hundreds of thousands of dollars, or do I want to have a reasonable wedding that has my family and friends and loved ones that's wonderful, it creates a wonderful memory for my spouse and I, but not go broke or go into debt doing that so that we can begin to fund some of these other goals, like paying off the car, like moving towards financial independence, like buying a home. So I think you have to sit down and prioritize those, and depending on where wedding falls in your priority, will dictate how you begin to save and accumulate for it.
Nick, one of my biggest problems with debt, look, I use debt as a tool, but one of my biggest problems in America with debt is the bridge of additional consumption because they give you the false mirage of saying you can do it all. And I'm just telling you, that's not what life is like if you want to be successful. There's going to be incremental, disciplined decisions you have to make between this choice or this choice and which road you go down. And I do think you can do both, but there's going to be trade-offs. You can do, because I feel like you threw the wedding in there as kind of a caveat, is like, maybe I need the additional year of paying for the car so that I can use some of those resources towards the engagement ring or whatever else, or the wedding or honeymoon, whatever, component of that expensive endeavor of getting married is. And I would tell you that maybe the decision is instead of buying the nicer car, you have to make the incremental decision. Look, you've already locked in this significant other. And by the way, nobody cares what car you drive anyway. That is like a fallacy. Only the marketers tell you that people care about your cars.
Yep.
So think Corolla, not Land Cruiser, and maybe you can do both. And but don't just assume you can get the nicer car, nicer engagement ring, and the way you're going to bridge it is with that extra debt or financing, because I feel like all of America does everything at $200 a month more by just increasing the amortization table. And that's why you see more and more cars financed for 7 years.
Gross.
That now this is getting to be the average. That's not the solution. You don't want to be like everybody else. You want to be a financial mutant.
Love it. Hey, congratulations on the pending nuptials. That's awesome.
Maybe. They might not like this car. I'm kidding.
All right. Nick S., thank you so much for your question. And thank you for everybody for tuning in. We love answering your financial questions and helping you find that better way to do money. You can join us every Tuesday for a live stream at 10 a.m. Central. And be sure to be subscribed so that you can catch all of the new stuff that we're doing, like our new show, Making a Millionaire, premiering February 3rd at 8 a.m. You can go to moneyguide.com/makingamillionaire to find out all of that info.
Guys, we have had a blast. And I love, we say it all the time, but I think it definitely makes sense when we're talking about making a millionaire. We share that there's a better way to do money. And this is a way for us actually to show you that with real people, real stories, real strategy. Making a millionaire, I hope, makes an impact. I really do. I hope that this is something that makes every one of you better with money, because the heart of what has created the Money Guy Show and now is the heart of what's making a millionaire is we just want you to be better with your money. Take an active role in it. And we're going to keep creating content. We're going to keep educating you. Thank you for reaching out and sharing with us the impact it's having on you. Thank you for all of you who do take the relationship to the next level and become clients. We don't take any of it for granted, and that's why this is all part of the abundance cycle. It really is. Earlier, we answered a question on how do you negotiate a better salary. And Bo, you were talking about do win-win scenarios. That's exactly what the abundance cycle is. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy Team, out.